This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have this week Charles Hugh Smith, well-recognized writer on the web, who is the publisher of the website of2minds.com. Good morning, Charles, and welcome to our second session this week.
Thank you, Gordon.
Charles, the first slide I have up here is a slide that I put together a few years ago now, and it was showing the increase in money supply in the United States since we came off the gold standard, one of the little red dot here at the bottom in August 15, 1971, and the dramatic increase that we've seen versus the industrial production or capabilities on a worldwide basis. And you can see that it's just totally out of touch. And it's like the Tower of Babel. Trees don't grow to the sky. That's what this chart immediately begs. But, like a heroin addict, enough is never enough, and I'm questioning whether, in fact, that's what's happening. And, our discussion here this morning of peak everything and whether that day has arrived. The second chart I have that I brought is showing here, and it's a combination of two charts, and something for years we kept looking at what I'll refer to as the marginal propensity of money, and that is for every dollar of stimulus that the government puts into the economy, typically have always been able to get a minimum of $2 to $4 worth of growth out of it, at least short-term growth, not necessarily sustainable, but certainly growth that was always more than the dollar we put in it. So it's worked. But in 2008, that changed. And suddenly that dollar of growth, call it debt saturation, call it what you would, is not delivering that. And on the right side are some charts that are put out recently by Trim Tabs. This is their charts that I'm using, that shows you with a little box on the right-hand side that today growth is, in fact, now only giving us 33 cents to 25 cents on that dollar, so it's no longer returning any of the investment. So stimulus spending doesn't work.
I would summarize these charts as peak debt.
Yes.
We're talking about peak everything. We can start what you've described as peak debt, which then influences all the other peaks that we're going to talk about.
Couldn't agree with you more, because a lot of the peaks we've had has been overinvestment, malinvestment, and a lot of that has been based on the fact of simply mispricing. When you get too much money out in the circulation, you get mispricing of productive assets, or maybe another way of saying it, the overpricing of non-productive assets.
Yes, exactly.
Charles, I've got the first slide up that you brought with you today.
This chart, Gordon, shows an overlay of the stock market represented by the Dow Jones Industrial Average and global oil production. Interestingly, we see that the Dow stock index rose in very close correlation with the rise in global oil production. This expresses the connection that we have between global growth and the availability of cheap, abundant oil. And so as oil has become more abundant and its prices stayed low, then it was, of course, the fuel for global growth and economic growth and the rise in profitability that's reflected in the rise in the stock market. Well, as we all know, peak oil doesn't mean that there's no oil left. It means that oil becomes increasingly expensive and scarce. In other words, once we have to drill down 6 miles below the Gulf of Mexico and then put high pressure gas into that line in order to extract the oil, that's a different story than punching a hole in the ground and oil gushing out in vast quantities. So this chart suggests that we can anticipate as global oil production falls that the profitability and the pricing of assets as reflected by the stock markets will also trend down.
What's really troubling to me, Charles, is that the United States and many countries in the world is built on cheap energy. Mm-hmm. We have a transportation industry. We built our shipment of foods, for example, I call it the $1,000 salad. It's built on certain dollars per mile that it costs for transportation. Well, with peak oil and it becoming more expensive to, in fact, locate it or find these kinds of energies, that's going to change all of the business models and not to the good.
Precisely.
That's normal. It's negative in that the results will be negative, but it's more important that we recognize why it was the way it was during the 1900s because of our ability being self-sufficient in energy and what it means going forward, and therefore to adopt policies that will do that. Unfortunately, all we've had is a lot of talk. I don't think we've had effective policies, but that's for another discussion.
Yes. This next chart is another peak, which we might call peak employment. And this is a chart from the Federal Reserve that shows the civilian employment population ratio and the S&P 500 stock index. And the civilian employment population ratio is simply the ratio of how many people in the population have a job. And we can see that it peaked here in the early 2000s, the dot-com era and what we now know is the start of peak debt. And then employment fell off in the next recession and then shot back up in the housing bubble and credit bubble. And now the stock market has recovered. It doubled off its March 2009 lows. But employment, the number of people in the population with a job, has crashed to like levels last seen in the early 1980s recession. It has not recovered. So what we have is a collapse in peak employment, but the stock market's been rising as if employment has recovered, and it hasn't. So there's a structural divergence here between what the stock market is telling us about the health of the real economy and what employment is telling us about the health of the real economy.
I think the stock market's telling us that we're just printing money. And when you put that much money out, the stocks become worth that much less. So in nominal values, they're going up in price. Yeah. I would argue in real terms they're actually falling, and I showed that separately.
Yes. Excellent. Next chart here is showing what you and I were discussing before we started the show, which was household liabilities. In other words, how much have households borrowed? And we can see here that the sum of money that households have borrowed is on a scale that's far above their actual wages and salaries. Their borrowing is following a curve to infinity, while wages, which were nominal, not adjusted for inflation, because once you adjust wages and salaries for inflation, they're basically flatlined for the last 30 or 40 years. But so now the household liabilities has rolled over. We've reached a point where, as you said, debt saturation, people can no longer qualify for borrowing more money. They're completely maxed out. They cannot leverage whatever assets they own or whatever income they have into more debt. We've reached peak debt, and now we're on the downside.
I would argue, and it's a very good point, the households have no collateral to post to be able to borrow more money, and they have no real income sufficiently to borrow it, so they just don't have the means. But the point I would make is the corporations themselves are now having a shortage of quality collateral to be able to post, and the banks, and this is the huge issue in Europe today, is the banks themselves, in spite of the litro, have now run out of collateral in which they can post. So we've had all this malinvestment, Charles, which has resulted in assets themselves that are now being called into question, and assets that can't even be posted to be able to borrow more money to sustain the debt. We reach a point like this Tower of Babel where everything starts to wobble. You never know when the tree's finally too high to grow, do you? Until it falls.
Yeah, and I think you summarized the critical role of collateral extremely well. We can look at housing, which most of us understand that if you put 20% cash down on a house, so you're going to buy a $100,000 house and you put down $20,000 and you're leveraging $80,000, that's 4 to 1. You've put down $1 of collateral and you're borrowing $4. Well, if you put down 3%, then suddenly you're almost at 30 to 1 collateral. And so if that collateral goes away or it diminishes in even a small amount, then your collateral is gone. You have zero collateral in that house.
Can you imagine the banks that were running in Europe right now, running 50 and 60 to 1, Charles? So you're running 60 to 1 and you lose $1. the magnitude of that is just absolutely devastating. Or if you have a bank run where the depositor takes out $1 and you're leveraged at 50 to 1. Just phenomenal issues here that are going on with the misunderstandings when you get to peak things, peak abilities to leverage and gear balance sheets, for example, is the point I'm trying to make.
Yeah, absolutely. We've reached peak leverage as well as peak debt, and those are, of course, related. I think our next slide is on housing. And here again, we see an exponential rise in the price of housing from the early 2000s up to its peak around 2006. And of course, as we've discussed, that we saw that reflects that exponential rise in house prices reflected an exponential rise in debt and leverage. And so when the debt bubble and leverage bubble popped, then of course housing was simply a reflection of the debt bubble. Now we see that the federal government has gone to extraordinary lengths to support the housing market with direct subsidies and super cheap, mortgages and, guaranteed loans. I mean, really, Gordon, it's one of the most shocking things to me in this last decade is the private mortgage market has essentially vanished. That something like literally 99% of all mortgages that are originated are guaranteed in some fashion by the federal government or a federal agency. So
that's exactly right, Charles.
And so we see in this bubble that we've returned to the house price levels of around 2003 and 4, and of course that may be different in your particular locale, but nationally. And you can see that we actually could fall another 20 or 30% just to return to the past average prices of homes. And so to say that the housing market is now fixed, like a lot of people are saying, and it's on the rise, and all this kind of hype, this chart suggests that might be a little premature.
If I was a member of the National Housing Association, I'd be putting a positive spin on it too. But and that's all you read, and that's where the numbers all come out. But not with my money. This chart, as a technician, says you got another 15% here. End of discussion. Gary Schilling's out saying 20%. And I just look at, and you and I have talked about this in the past, Charles, national house formations, they're going down. We've got more people actually moving back with consolidating housing. Kids are not leaving homes. They can't afford it anymore. We have more people renting. So, okay, and we've got huge shadow inventory of housing. We'll work through those problems, but I think there's another 15 to 20% price incentive that's got to be built in here.
Yeah, referring back to the previous slide, if we have peak employment and employment is faltering, then how can people afford to buy very costly houses? It's impossible unless you give them free money. And then that distorts the market, and eventually that leads to another collapse.
But if you tell everybody that housing's bottom, then you get some people will start to buy. I suppose that's the logic here, right?
Yes.
As opposed to telling them the truth.
Yes.
I hope I'm wrong.
Right.
But not with my money.
Speaking of the truth, I think our next slide is a shocker for me. It shows state government tax collections, particularly property taxes in the United States. Again, a chart from the Federal Reserve of St. Louis. And it shows that property taxes rose smartly through the 1990s boom economy. And then as the economy started softening, then property taxes actually fell from like around 1999 through the 2001 recession. And then as the housing bubble perked up, then of course, naturally, as valuations rose, then property taxes rose quite sharply from 2002 up to about 2008 or so when the housing bubble popped. And then normally, as we see in this the past recession, when housing valuations fell and the economy softened, property taxes fell. This, of course, reflects that, the market has softened and housing prices have declined. Well, in the recession of 2008, 9, 10, 11, 12, we see that property taxes actually rose sharply because it shows that government is actually increasing property taxes regardless of valuation. And I think that this reflects peak government and peak taxes. In other words, as the economy softens, as employment declines or stagnates, as collateral vanishes, is the government collecting less money? No, it's actually squeezing more and more taxes out of a declining or stagnating economy to support its own peak growth. And then very recently, we see that property taxes are starting to roll over as I think the taxpayers are crying uncle, or as valuations decline to the point that the government can't raise taxes fast enough to catch up with the decline in valuations and collateral.
You see, it's like cracks in a dam. One cracks here, and then it weakens it, and it cracks over there, and we're just seeing it right across the board. And this chart really brings it home here, Charles. And I was thinking as you were talking about taxes, there's so few, and I wrote about this in my thesis paper, of Americans that are actually paying, as individuals that are paying taxes. Less than half of Americans now are actually paying taxes of any substance, minor taxes, or no taxes at all. And in the Fortune 500 corporations, how many are paying no taxes, and what troubling even greater is how many are actually living off tax rebates, though they're making outstanding types of profits. So the tax revenues themselves of the games that you can play in a very complex tax code have now left us with the taxes not coming in. Is it any wonder they're trying to squeeze everything they can out of property taxes and any other kind of tax they can find?
I think that it kind of relates to your debt saturation chart in the sense that, and this I think is happening in Europe, is that when you start raising taxes on everything, sales tax, property tax, income tax, fees for this and that, then what happens is you end up collecting less because people are driven into the black market, at the lower realm of the economy, or very productive people just decide to heck with it. I'm not going to work that hard in order to pay 50 or 60% of my earnings in taxes. I'm just going to work less, or I'm going to sell my business and get out.
Exactly what's hidden behind these charts, Charles. I grew up in a country and watched it go socialist. And what happens is you get two groups. One says, I'm not going to work this hard anymore because it's getting taxed away. And then the others you get who just game the system for the handouts and live off what they refer to as the dole. And all the behavior starts to change. And it starts to change when you have handouts and and the taxation that goes with it. And it's not a subtle game, but unless you catch it early in the cycle, you end up with a culture that's not supportive of risk-taking. And then it becomes very supportive of government handouts. And then when you get a population, and I look at Obama going into the next election, when you got 100 million people, not including government employees, living off government handout, it's going to be hard-pressed for them to want to vote for austerity and government cuts, isn't it?
Yeah.
So now you just define public policy. So all of a sudden, the government then becomes the servant of the legacy social handouts, and that's it. So it's not a subtle game, but it subtly transitions. And I am afraid in America we may have crossed that Maginot line. Charles, we're getting near our hard line here. And any other comments you wanted to make?
Just to add to your last comment, that we can see, I think, that there's a causal correlation between peak debt, peak government, and peak taxes. Those are not independent features of our economy. Those are causally linked. You get peak debt with the government borrowing vast sums, then you get peak government soaking up all those resources, seeking peak taxes in order to try to service that peak debt.
Exactly. Very well said. They do tie together. Another point that I would make here, Charles, and I had a series of I went through with Ty Andros where we looked at growth and the validity of growth in the country, actually around the world, measurements, and as we measure something called GDP, and I won't take you through it, but what we showed in quite an amount of detail is how simply flawed today our measurements of growth are. And therefore, and the bottom line is, in fact, not only the United States, but globally, we're actually shrinking. We have negative real growth. And we're contracting. And when you start in a contraction, whether it's hidden or not, it's the reality is we are contracting. Then, in fact, all these peaks that we're referring to get more difficult or occur faster. And they have occurred. And that's where you're seeing them all rolling over and contracting. Because when you don't have the growth to support the debt, for example, you don't have the growth to support the taxes, for example, you don't have the growth to support the requirement for energy, it all pulls back in. And that's what we're in the process of. This can also be healthy and not all negative, Charles, because it says in many cases what we've done is we pulled future growth forward. It's like we've eaten tomorrow's seed corn, and what we've got to do now is take maybe possibly the next decade to grow into the levels that we had before. Unfortunately, with the kinds of debt that we've now incurred, it's not going to be an easy growth. It's going to be very, very painful, and there's going to be major adjustments on our living standards. And it's not something we can hide from. It's a fact of life. There's no free lunch, and we're going to have to pay for our lunch that we've already eaten. That's what's happened. The bill has come due. We need to wrap now, Charles. In closing, is there any way that our listeners could learn more about your writings, more about your book, Resistance, Revolution, and Liberation, and how they would find your website?
Well, I'd certainly be happy if people stop by to see what I have to offer at of2minds.com, and I appreciate you letting me mention it yet again.
Talk to you in 2 days.
Okay. Thank you, Gordon.
Talk to you again. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.